Aashish Somaiya joins us, Managing Director and CEO with Motilal Oswal Asset Management. Ashish, good morning. Thank you for joining us. When we met last, that was once upon a time, 3.5 months ago, things were looking rather up. There was optimism. Flows, despite market volatility, were looking robust. What is the update at your end, both at PMS level and mutual fund level?
Yeah, so I'll start with the mutual fund first. I think the flows are actually, if you see, September was like a month of huge bounce back. And I think as we speak, my sense, October numbers are not yet out, but what I understand by observing, the market and by talking to people, my sense is that the flows are muted. Let's say, for example, if October was close to 9,000 crores net flow, September was 9,000 crore net flow. My estimate for October is anywhere in the range of 3,000 to 4,000 crore net.
So half of what we get.
Yeah, so my sense is that October there is a significant decline because there's a huge bounce back, right? In September, all these large cap, mid cap, everything bounced back by 9 to 10%. So I think when 100 rupees becomes 90 and 90 comes back to 100, a lot of people who came in 2018, I would call it a relief redemption on a lighter note, but that does happen.
As far as net picture, right?
Yeah, this is net.
The most important number is that has the SIP trend got shaken? So at the schemes which you manage, and I mean, even though you're not a large player in the SIP market, but you still have a reasonable book. Has the SIP investor panicked? Are they saying, oh my God, what did I do? My 3-year SIPs are not making money. What long term? That's all nonsense. There is nothing called long term. 3 years, if I have not many, 5 years, I'll not make money. Are you getting that kind of a panicked cancellation?
No, so there's no panic cancellation. The number of people whose SIPs were expiring or number of people who were by cancelling SIPs, that has remained flat for the industry, whatever I've observed. Fresh registration of SIPs has seen some kind of headwind. There's no doubt about that. The other thing to keep in mind is that all of us see net numbers, but the point is that there is a different guy who's giving the inflow and there's a different bunch of guys who are giving the redemptions. So the point is that the guys who stop the SIP or whose SIP installments are over, are they redeeming or not? There's no way to know because we get a total redemption number and there's no way to know whether it's the SIP guy who's redeeming or it's somebody else who's redeeming. All those things are not possible to know. And I don't see that I think behavior for SIP guys would be slightly better than the guys who are cutting checks. But, if somebody's SIP stops, is he redeeming or not? No way to know, right? So I think that this whole thing of seeing the net flow, it tends to be a bit misleading. We have to see how many people are cutting checks, how many SIPs are going through, and how many people are giving redemptions. And why I'm bringing this up is because the number of people who are cutting checks every month, that is discretionary investment, has fallen dramatically. In December 2017 at the peak, the gross inflow was 45,000 crore when SIP input was only 6,000 crore, which means 39,000 crores worth of checks were being cut. Now we are at a gross inflow of 22,000 crore and SIP is about 8, which means only that 39 has become 14. So that's where the fall in inflow is the big issue. It's not so much just about redemption. Redemption is happening at a certain, if you have people's money at a certain rate, you will get attrition every month because it's their money, they will want to take it out. And liquidity is a feature of mutual funds. I think the big issue is the fall in inflows. I think that's the key part.
But what's keeping people away? Is it because they've badly burnt their fingers in the small and mid-cap carnage?
I think, for mutual, there are different strategies out there, but mutual funds, I think small and mid cap in pockets, yes, there's no doubt. Because I think even in mutual funds, about say 10 to 15% of the entire industry's assets is in small and mid cap. And my sense is everybody would have had that in their portfolio and that is down. So inflow going down partly is because of that, because when people's, your recent investment doesn't show a great result, then, you don't want to, you feel worried about committing more. So that is definitely one thing.
What is your pitch to investors now? The stocks in which historically Motilal Oswal AMC as a house has invested in, you've always prided by saying that, look, we will buy the best businesses.
Yeah.
We've been criticized in the past for being expensive.
Yes.
But those stocks have delivered. Now, the naysayers are saying you don't make money when you buy stocks at P multiples of 70 times or 80 times. You don't make money if you keep Bajaj Finance at a price book of 8 times.
Sure.
How would you defend this criticism?
So, to answer this, I'll just say one disclaimer. Whatever I'm speaking, I may own through my mutual fund. I don't own any of these stocks. And we are discussing regarding the mutual funds or the PMS, whatever.
We're discussing a concept.
Concepts, yeah. So, like you were saying about Bajaj Finance or iShare in the past, etc. Now there are notes which are being made about talking about HUL or Bata and, quality is in a trap and those kinds of things.
You've read that. Have you seen that show or you've reed that note?
I read the note and there are many notes.
I'll send this show link also.
Yeah, of course. I'll run through it for sure. I think that... first I think is that there is a responsibility, because we're the torchbearer or one of the torchbearers of, and we have our own execution challenges at times, no running around. But because we are one of the guys who have been professing quality, the first thing in this whole conundrum I find is that nobody's defining what is quality. And my humble submission is that a few B2C consumer-facing companies are actually not the whole and soul of what quality is. That is first point. Second point in this whole conundrum, the time horizon of investing has not been taken into consideration at all, because what happens is there are some people who believe that they will always be at the frontier of the next cycle of the market. So what they think is that when growth turns to, when quality is out of fashion and deep discount will actually start flying, then I'll be positioned at the frontier and I will get it right. It doesn't work that way. Our belief is that we will always stick to our philosophy and customers will ensure style diversity in their portfolios. So there is this whole thing about long term and short term. But I would go back to the original point. I don't think quality starts and ends with a few consumer-facing companies. Look at it this way. A year back, a lot of insurance companies were at half the price that they are now, right? So our biggest successes in the last 1.5 years have come from owning disproportionate insurance compared to where the benchmarks are. That is one area of success. So I think that, and quality has always been perceived to be expensive. And the last point is that we ourselves don't own most of the stocks which are listed out there, by the way.
You own a lot of autos.
But,
yes. So, see, that's a question.
Like hurting, is that a position you are thinking that, look, EV, slow down, or you think as a house that auto is something which is going through a cyclical pain, and whatever we are talking about EV, Uberization, that'll all settle down?
I think that sometimes the narrative tracks the price. That's the whole issue. Look, we all say that the price will track the narrative, but a lot of times our narrative starts tracking the price also, which is a bit of a challenge when you're managing public money, explaining to people. But on your auto question, in hindsight, when we made a lot of money, maybe we could have taken some off the table. But when we were in the thick of things, we were pretty sure that this is all cyclical in nature. And that's where I'm saying that narrative changes with price. So we've stuck through it and we are looking smarter than what we were looking in October last year.
Right. But Aashish, tactically, what's a prudent strategy from, if someone has to deploy fresh money by way of SIPs for the next 3 years? And I'm picking a specific time period of 3 years. Are you better off putting a larger allocation to small and mid caps? Because now everyone's like, finally they will begin to outperform. Yeah. Or would you say that, be safe, stick to large caps, that's where your larger allocation should be?
See, actually, a lot of these things, when Nikunj was asking, I mentioned that it's incumbent on us to define what is quality before we start a debate. So same way, look, what is happening is this whole small and mid-cap space is gigantic. It's all being muddled up. Now, I'll give you examples. Let's take, and this again, like I said, it might be in the portfolios, but I don't own these things. Sure. But take an example. The largest luggage maker in India is 5,500 crore market cap. So are you going to say that jettison it just because it's a small cap company? Answer is no. Most domestic pharma companies which are inward looking domestic businesses, they are all mid cap companies. A lot of financial services, NBFCs, mortgage finance companies which have nothing to do with this whole developer funding mess, they are all small and mid cap companies. A lot of the auto ancillaries are small and mid cap companies. So I don't think that we can jettison all of this. On your question, I would say definitely one should invest in mid caps. There's no doubt about it. But as long as we are going to paint everything with the same brush, investors won't get clarity. I think that is the big challenge. Because when the space has declined, everything has declined 30-40%, and people are not willing to be discerning enough to understand that what should have fallen and what should not have fallen.
What does one do with the NBFCs now? You've also been fairly constructive. They're going forward, given the pain the sector's been through, given the kind of commentary coming in from the government. What next?
No, so we are very actively looking at mortgage finance. The reason being that, one can't, just because of what happened last year, one can't imagine that the sector is either not needed or to be excluded or something. And there are very good companies which have actually I mean, they've have no issues with liability franchise. They've had no issues with wholesale real estate funding. But they are being treated pretty much in the same way. And you can clearly see some of them are actually returning back, not to the previous highs, but at least they are showing an improvement in trajectory. So there's no reason to believe that they're out.
It's sad, but it's true, I'm admitting it, that I've learned very late in my life the importance of asset allocation.
Yeah.
Right? It's important to get the asset allocation very right. An entry point sometimes tells you what your next 3-year or 5-year return would be. What, to your mind, currently is the entry point or the valuation entry point for mid and small cap stocks? When did we see these entry points last in the history? And then what happened subsequently after that?
See, I don't think we are back to 2011, 12 and 13 and those kind of things, but definitely we are close to 2014, 15 kind of scenarios. Because the big return came in 2016 and 17, right? But at the same time, 2014, 15, lot of stocks had started to show. So I say that I will not try to say that everything is a screaming buy, but if you are a discerning investor and in this whole melee, when few things deserve to be corrected, but everything got smashed. And there are so many technical things, right? Like last year, mutual funds rotating portfolios and the exchanges putting so many things into additional surveillance mechanisms. So many things happened all together.
When the mid-cap, I don't want to use the bubble, but the cycle got tricked. It was in 2008. The bull market in mid and small cap stocks started in 2014 and 15.
Yes.
It took 6 long years.
Yeah.
If I'm assuming 2018 is when post LTCG, the mid and small cap stocks will start reversing. This is just the second year of correction.
Yeah.
Which means if I go by history,
yeah,
maybe another year, maybe 2 years before these stocks they bottom out and the real bull market could be 4-5 years away.
I think so. I really feel that, look, I'll tell you something. Like last year when the index fell, we also fell as much as the index. What is giving me confidence is that in this year, look, I know that there are a lot of investors who watch our discussions. So for a moment also, I'm not trying to tell investors that please draw comfort from my relative performance. Or I'm not trying to say that I'm sleeping better because I'm beating the index. We're here to make money for clients. But the limited point is that last year when it fell, everything fell and we were doing as badly as the index. I'm talking about small cap. This year, there are many of our stocks which have started to, and we are like outperforming the index like by a mile now. So what I'm saying, why I said this is that if you're a discerning stock picker and if you're able to understand that, everything, we've also had execution issues. There are a couple of stocks which I know will not bounce back and, we kind of got out because we made mistakes. But by and large, out of 20, happy with 17, 18 stocks and they've started to return.
Okay. Ashish, just very quickly, we are completely running out of time. Asset allocation or rather portfolio allocation for the next 3 years. How much percentage-wise into large caps, how much into multi-cap, balanced, fixed income separately and small and mid caps?
So I would say that...
for a conservative investor.
Yeah, if it's conservative, then maybe 60%, 70% in multi-caps. Because if you see in our industry, most multi-cap funds do stick to 70, 80% large cap. So I would say 60% multi-cap if you are conservative and at least 20, 30% in mid-caps. And when I say mid-cap, I'm basically not going by any textbook definition. Basically, before the definition came, we used to think $500 million to $3 billion is mid-cap. So I would stick to that.
Okay. Great having you on the show with us today. Thank you so much for taking the time out and speaking with us. That's Aashish Somaiya from Motilal Oswal, talking about asset allocation, talking about how the market and, of course, your portfolios could look like going forward.